President Trump seems determined to make America great again. But his actions in the first month of his presidency have actually made the European stock market greater. Over the last 2 years, US stocks have comfortably beaten their European peers. But so far this year, the Stoxx 600 index, which tracks 600 European and British companies, has outperformed the S&P 500. So, what is behind this shift? And is it time for investors to move some of their US dollars to Europe? First, let's look at how the Stoxx 600 performed compared with the S&P 500 last year. As we can see, the S&P 500 jumped over 23% for the year, but the Stoxx 600 only booked a modest 6% advance in 2024. But now let's look at the performance of these two indices this year. We can see that the Stoxx 600 index outperformed the S&P 500. The question is, will this trend continue? It's hard to know for sure, but these are some indications that it might. Trump's policy agenda, which is pro-US growth and pro-tariffs, could result in a strong US dollar relative to the euro. This could benefit European companies as American consumers can take advantage of the dollar strength in Europe to purchase things like luxury items from LVMH or Kering. A strong dollar could also hurt US companies that export goods and services to the rest of the world. One of Wall Street's worries is that US stocks are very expensive, much more expensive than their European counterparts. In fact, there's never been a bigger valuation gap between European and US stocks. On February 3rd, the price-to-earnings ratio difference between the S&P 500 and the Stoxx 600 was one of the largest on record. The S&P 500 traded at 21.88 times forward PE, while the Stoxx 600 traded at 13.95 forward PE. But it's not just valuations. Wall Street sees more monetary policy support from the European Central Bank than from the US in 2025. Investors actually expect around 100 to 150 basis points of interest rate cuts from the European Central Bank this year, compared with just around 50 basis points of rate cuts by the Federal Reserve in the States. A potential economic recovery in China could also benefit European markets, as they're a big consumer of European goods, especially for luxury or consumer-related brands. So all considered, is it time for US investors to buy more European stocks? Some high-profile investors like BlackRock's Larry Fink seem to think so, but other financial experts are not so sure. This wouldn't be the first time European stocks started the year strong only to lose momentum. And just like there are several opportunities for European stocks, there are also risks. First of all, tariff threats from the US could disrupt the European market. There are also concerns that heavy-handed regulations could hurt European companies. Last year, former European Central Bank head Mario Draghi outlined reforms that could make Europe's economy more competitive. But implementing some of those recommendations could be arduous and expensive. And finally, the size of the US stock market is much larger than Europe's. As of January 31st, US stocks were worth around $63 trillion, while European stocks, including those traded outside the Eurozone, were worth around $17 trillion. So European stocks could be really attractive, but keep in mind things could easily change overnight.